On board Chakri Lokapriya as well of TCG AMC to talk to us about the fundamentals of the market. Chakri, hi, thank you so much for making time and speaking with ET now, and happy Yoga Day to you. To begin with, I wanted to discuss Tata Motors. That stock is sitting at 7-year high level. Do you believe there are more legs to this rally, or would you want to churn and pick up some other auto name now?
Good morning and thank you. And yesterday, Tata Motors released in its annual reports fairly encouraging details in terms of its cash flow. You know what we've been debating about, that it will generate free cash flows over the next couple of years, which is indeed seems to be on track, which is a very good sign. JLR has a lot of electric EV models coming out to replace and replenish its existing lineup. CV business is doing fine. And so, all these fundamental factors which have actually driven the stock thus far will continue to drive the stock. And I think, we still remain very positive on Tata Motors.
Right. Okay. I think the big news this morning and the big trend this morning is comments from Elon Musk after meeting PM Modi, saying that he's pretty excited about the future of India, saying that Modi really cares about India because he's pushing us to make significant investments in India, which is something we intend to do, and that it was a fantastic meeting. When asked very categorically whether he's going to do business in India, he's saying that it's still pretty much conjecture, but yes, hopefully in future, and that he should hopefully make his way to India next year and is planning a trip. I know this is all, a very long drawn thing, but just Chakri, Tesla coming to India, what could it possibly do to the dynamics of Motown here, and of course auto ancillaries as well?
It could make a very significant difference. If you look at what Elon Musk has done in China, they can now produce cars under 45 seconds, one car. So that's the kind of investment that they have made. And also what it does is a host of ancillary industries. The whole sticking point between Elon Musk and India has been about the percentage of import component, which is a good thing in India's favor if it actually gets more domestic in replacing the imports component. So I think it's not just an Elon Musk coming to prepare to manufacture cars, but the auto ancillary industry, which is a mega industry already in India and has the infrastructure and therefore will benefit significantly.
These businesses were commanding P multiples of 50, 60 plus at the peak of COVID, peak of testing, peak of COVID, peak of market cap. But now life is back to square one. But when life is back to square one, it means that these businesses are still growing. When I say these businesses, diagnostic businesses. How would you rate this sector now?
The stocks have fallen a lot. Two things have happened. One is competition has increased within the sector, and therefore the margins have come down and will not unlikely to go back up to, let's say, 3-4 years ago. Now, a lot of hospital companies are also in the diagnostic space, and therefore margins will be lower. Second, what will help the sector, kind of provide support to the sector, is all those elective surgeries, all those elective treatments, which all came to a stop during the COVID, have come back very strong within the hospital chains and standalone hospitals. And mind you, standalone hospitals are still the driving force across India. The chain's very small market share. So which means individual diagnostic chains benefit from the growth of standalone hospitals. So from a moderate return perspective, I think still the diagnostic companies do look okay. In terms of their outlook, yes, because standalone hospitals are the bread and butter of this country in terms of market share. They do have a long run to go.
Okay, NL, because they've categorically clarified that there is no breakdown of a joint venture with Russia's TMH and that the MOU is still valid. Remember when this concern really propped up on a breakaway of that MOU with the Russian counterpart, you did see some amount of pressure on these railway names as well. And Chakri, railways, defense, that really seems to be the underlying theme in the market. You believe there's still further headroom and still opportunity to buy into this trend?
Indeed, there is significant trend because what is happening with number of companies because of the underlying change. Just both the railways itself is moving to Vande Bharat, faster trains, longer carriages, longer train runs. And so with all this, they're just moving away from just building wagons. They also rail systems etc., becoming very important. Companies like Titagar Wagons, which have gone up like some few 100% over the last 1 year, are still inexpensive stocks. They still trade about 17, 18 times. So I think there's still room for these railway stocks.
Okay. Chakri, but why do you say that? Because these stocks are, like you said, multi-year high, valuations are slightly stretched. And again, railway capex is not like FMCG where margins are 30% or 40%. These are long cycle businesses where you get the order book today, it will be executed in 4-5 years. It's not like making a pizza that you can make in 30 minutes. If you're making railway backends, it will take 3-4-5 years.
Yeah, absolutely right, Nikunj. And in fact, that is going to be the driving force, which is, as you said, the big order books. So this provides revenue visibility for the companies, for all these companies in this space for the next at least 5 years. Yes, the order book can be very lumpy and therefore they can miss quarterly estimates and therefore they'll be volatile. But in addition to just making wagons, they're moving up the value chain. They're getting some import substitution and therefore the value add, therefore the margins of these companies can kind of increase over the coming years. They've had a phenomenal run, 300-400% up in depending on the stock for the last 1 year. But the valuations are, given the margin profile, are still about, take Titagar Wagons, for instance, 17, 18 times, which is still not expensive given its earnings growth rates given its order book.
Right. Okay, electronic manufacturing.
In Shriram Transport Finance, what do you think it means for Piramal Enterprises? We are analyzing one side of the story, but there is also a seller who would benefit.
Indeed, as you rightly pointed out a few minutes earlier, Piramal originally wanted to get into this from a strategic perspective, and due to a change of their own internal planning procedures, or rather their focus, this became just an investment. And it was a large investment, clearly. So I wouldn't read too much into, from a Shriram perspective, why they're exiting. It's a good thing they're exiting for Shriram. And in the case of Piramal, it didn't fit into their strategic plans anymore. And they had a leveraged balance sheet. And they're on the course of mending that. And this will also help Piramal because it makes their balance sheet stronger.
Chakri, what is your view on Z? There is a lot of yes and no whether the merger will go through. But independently, do you see value in a franchise like Z?
There is indeed a lot of value in that franchise. But with the news flow as well as the confusion related to all those issues surrounding Z, makes it very difficult to, what will be the operations left. What is the combined operations is itself in question. So given that level of uncertainty, I think it's best to stay away from Z.
So that's about Z Entertainment. It's back at 2021 lows. But Chakri, what about the entire IT space? We were just discussing Cyient, one of the names from that, universe. What about the other mid-cap, small-cap IT names? Is there anything that you are identifying?
Companies like Cyient or Coforge, which are targeting more specific areas, unlike the large cap IT like Infosys, TCS, are better placed because of their product focus. Fortunately, is in line with the cycle of technology spend. And again, if you look at the large cap itself, their top end revenue guidance is pretty much very reasonable, anywhere between 4 to 7%, and going into the next quarter. So the big fear is that will there be a downgrade of the estimates going into the second half, which, bearing, depend upon what Fed does. Again, there's still that huge uncertainty which has been about interest rates, which has been holding back some of these services companies. I think tech stocks have largely bottomed out, including the large cap. The small mid-cap IT stocks have actually done very well.